Hello and a huge good morning to everybody to our webinar series today. My name is Aileen Deasy from the Enterprise Supports team on Fáilte Ireland, and I'm delighted to see so many of you tuned in today and to take time out of your busy schedules. It's snowing here in West Cork, so I'm not sure where it is where you are, but I hope the sun is shining. So here we are on yet another Zoom call, but we really hope over the next few weeks and months that we get to see each other a lot more face to face. So moving on to our topic of the day. As we move from survival into recovery, we on the enterprise development team wanted to bring you supports that are really relevant to you right now. So we know financial stability and viability are the bedrock of every business, and we are acutely aware of the challenges that you have been facing, because all of these ultimately affect your bottom line. So today, we're going to help you maybe navigate through some of the kind of current financial environment, and we are focusing on debt financing. So just before I hand over to our speakers, Maria and Declan, who will kind of take us through that journey, many of you will want to be informed about areas like, non-performing loans, different banking solutions, getting a deeper understanding of the types of loan facilities that are available to you. And, so hopefully we'll bring that insight to you today. So just to introduce our speakers, so many of you will know Maria and Declan from Crow. Maria has over 20 years experience in this sector and has an in-depth knowledge both operationally and financially. Maria works with businesses on project feasibility, future financial projections, and asset management. And Maria also advises clients on future strategies and investment needs for achieving those forecasted, achieving that forecasted performance. And again, it's from a financial and from an operational perspective. So I think many of you will find that useful today. And then Declan, so Declan has 14 years of experience in this sector on all aspects of restructuring assignments, including things like liquidations, examinerships, receiverships, and informal restructuring. And Declan has managed restructuring projects with a wide range of financial situations, including the pillar banks, but also alternative leaders and distressed debt funds. So I'm going to pass you over now to Maria and Declan, and I'll see you all later on for our questions and answers. So over to you, Maria.
Good morning. Thank you very much, Aileen. I'm Maria. I'm here with my colleague Declan, and we both work for Crow. Just to let you know, we've a full in Crow. What we are, we're accountancy advisory firm, but we have a dedicated advisory department to the hospitality and tourism sector. And so because we have expertise across the full spectrum of accountancy, tax and corporate finance, we have access to those areas. And so I find that particularly useful. If there's a question that I don't know, I can ask one of my colleagues. So just to go through what we're going to talk about today, we are going to look at the different types of debt financing, understanding your debt facilities, non-performing loans, banking solutions, understanding debt security, and formal restructuring options. Also, just to be aware when we're talking and discussing all things debt, not everything may be relevant to you today. So we're trying to cover as much as possible. And it's not all negative. There's a lots of positive with having a good capital structure, that good debt equity ratio. And really what we want to do today is to give you more information in relation to debt. So whether you want to take on more debt, restructure what you have, or just understand the parameters around the different types of debt financing. Also, just to let you know that throughout the presentation, if we talk about the pillar banks, they're the main banks that you would know of. And we also talk about alternative lenders. And some of you may have heard of those. They're newer lenders who are in the marketplace and who are lending to the hospitality industry. Okay, so first of all, let's, I think Declan's going to go through some of the types of debt financing.
So good morning, everybody. As Maria said, the first area we're going to touch on is a quick overview of the different types of loans or debt financing that you may have in your business. So you may use some or all of these, and they include short-term loans, long-term loans, overdrafts, leasing, and invoice discounting. But before we go through each of these in a little bit more detail, it's important to have a comprehensive view of all of the areas in your business where you owe money. And we've prepared an example balance sheet just to highlight this. So in this slide, we're going to look at, as I say, an example balance sheet with a view to looking at the total debt of a company. So in this webinar, we're just looking at the debt element of a company. We're not focusing on the equity element. So as the balance sheet shows, it's just got the debt side of the business. So it's important to have a comprehensive view of where you owe money and who you owe money to. It's also important for the bank and for your lender when they're reviewing your debt facilities. They'll be interested in who you owe money to and who they're competing with for that cash flow. So a key element they'll be looking for is the non-bank or non-lender creditors, so your trade creditors, and in particular they'll be looking at revenue liability that you may have. In the example we have prepared, it's an exaggerated case, so it's comparing a business pre-pandemic in December 2019 versus December 2021. So as we start to come out of the pandemic, and the business that we have, the example, it shows this company has suffered quite badly during the pandemic and has significant losses during the period. So we can see that their cash has reduced from 250,000 euro to just 10,000 euro during the period. They now have an overdraft in place. So prior to the pandemic, they didn't require this. Trade creditors have increased by 50%. So they're struggling with the payment of their creditors. While the current tax liabilities have remained relatively stable, you can see from the long-term liability section of the balance sheet that the company has warehoused 240,000 euro of taxes during the pandemic. So in effect, they have an overall tax liability of 260,000 euro. The bank debt in the example has remained the same on the basis that we've assumed that their lender has provided forbearance and has given them an interest-only period during the pandemic. So as a result, the principal element of the loan has remained the same. So just on the left-hand side, you can see the total debt is all of the things you need to take into account. So they're the debt finance elements being long-term loans, short-term loans, leasing, overdraft, invoice discounting. But just to re-emphasize again, you need to look at the entirety of the debt, so your trade creditors, your tax liabilities, directors' loans, or any other elements that may appear on your balance sheet, accruals, for example. So now I'm going to hand back over to Maria, who's going to look at understanding your debt facilities.
Thanks, Declan. Okay, so now we will discuss each of the debt facilities. So before we go into these, what we want to talk about are some of the components of each of your debt facilities. So interest rate, for example. This covers both the cost of funds and a margin that will be over the bank or lending institution's cost of funds. Interest rates will vary based on the type of facility and the lending institution. For example, you might get a lower interest rate with the pillar bank than an alternative lender, but the alternative lender may give you a higher loan amount. So for their higher margin, they may take on more risk. Your loan term and your repayment term need to be looked at together. So they're two different things. So the term of the loan may be for 7 years, for example, but the repayment term or the profile may be based on 20 years. So when you first get the loan, it may be for a fixed term of say 7 years, but the repayment schedule will be based on a longer time frame, maybe 15 to 20 years. What this means is that by the end of the 7 years, the bank will rewrite it with another 20-year or 15-year repayment term. So you'll be pushing the capital out further. What some businesses will think about at the end of the 7 years is if they need additional capital, maybe to do CapEx or some type of investment. And if your repayment capacity and the projections that you would make for that investment would allow you to do that. So covenants, I'm going to go into a little bit later, and security, Declan will go into a little bit later. But in terms of the general terms and conditions that you would have in your facility letter or your loan agreement, what you want to know is what else is written into that. And are you keeping up to date with those elements? So what would those be? For example, statutory compliance. Are you keeping up to date with your fire safety certificate, your Fáilte Ireland registration, your liquor license, tax clearance cert? So any of those items, just to be aware that they're written into your terms and conditions, and that you know what's in there. So really in your agreement that there's no surprises, that you're aware of everything. So different types of debt financing, we'll just go through these quite quickly. You've got long-term loans and short-term loans. What are the differences really between them? So your long-term loans are used to finance the main asset or the building. Their payment term is usually 10 plus years in length. It's usually secured against the property or the business. Interest rates may be lower than shorter term loans, for example, but they may have some performance measurements or covenants attached to them. We'll discuss those later. Short-term loans are for a specific purpose, for example, capital expenditure project. Again, obviously their title, the term is shorter, maybe 2 to 7 years in length, and the loan is paid down quicker than a long-term loan. So some short-term loan examples, for example, would be during COVID with the credit guarantee scheme. So that was a short-term loan for a very specific purpose to help during COVID, and being up to 5.5 years in length. Overdrafts are usually for operational needs, working capital, or seasonality requirements. And the overriding principle of an overdraft is that it should be in credit at least once a year or for a certain period of time each year. Your interest rates can be higher than a short-term loan. So what you want to think about if you have an overdraft is how much you're using it, and how long you're in credit for. So what is it costing you? If you are not in credit for much time, you may consider getting a short-term loan. So you'll get a lower interest rate. So just consider the implications of that. So Declan here will just go through finance leases and operating leases and invoice discounting.
So there are two main types of leases that hospitality businesses will generally use, being a finance lease and an operating lease. So just to go through them quickly, a finance lease is typically used for equipment or machinery. Could be for a vehicle or for a piece of kitchen equipment, for example. At the end of the payments, you'll generally own the asset, and it's accounted for on your balance sheet in both your assets and your liabilities. You'll also see the interest payments in your profit and loss account. The risk of repair and maintenance lies with you as the customer in a finance lease. And a hire purchase agreement is a very similar product to a finance lease, in that you own the asset at the end of the repayment term. An operating lease is more akin to a rental agreement. The lease payments are just on your profit and loss, so it's an off-balance sheet product. It could be, for example, for a coffee machine or a photocopier. The risk of repair and maintenance lies with the lender in an operating lease. So if your photocopier, for example, needs to be repaired or maintained, it's the lender who looks after that. Sometimes the assets in question are purchased at the end of the agreement for a nominal sum. However, it's more common for a new operating lease to be taken out at the end of the term, as you get a more up-to-date version of the asset, being the photocopier or the coffee machine, for example. So invoice discounting is a debt product which addresses cash flow issues that a company may be suffering from. It's a short-term borrowing against unpaid invoices that you have issued. When using an invoice discounting facility, when you issue the invoice, the lender will give you a percentage of the invoice amount upfront, usually be 80, 85, 90% of the invoice amount. The balance of the invoice is then paid to you when your client pays the invoice in full. So the lender will take their fees and charges from the balance of the invoice that's due to you. And this would generally be somewhere around 1 to 3% of the invoice amount. The product is designed to alleviate short-term cash flow issues caused by giving your clients credit, be it 30 days or 60 days credit, while you have to incur the associated costs up front. So wages, for example, have to be paid every week or every 2 weeks. An example in the hospitality sector would be tour operators often pay at the end of a season, but you have to meet the costs to provide the service up front. As I say, the wages will be an example. So I'm going to again hand you back to Maria, who's going to look at covenants within debt facilities in a little bit more detail.
Thanks, Declan. So I suppose really what we want to say is that with the different types of debt financing is you'll have more than one. So you will have different types of financing over your business, and it's about matching the right product to the right need. So let's go into covenants. You know, what are covenants? It's a specific term or agreement within your loan contract. The majority of loans, particularly longer term loans, will have covenants attached to them. So it's important that you know what your covenants are. And the types of covenants applied to your loan will vary, but could include Ebitda leverage, loan to value ratio, debt service cover ratio, interest cover ratio, limits on directors' remuneration, or limits on capital expenditure. These will be some of the most common types. They may not apply, all of them may not apply to a loan, but you will have a mix of them. So we've given some examples on the next slide, but just to go through them, I suppose, in a little bit more detail here. What is Ebitda leverage? It's a multiple of debt to Ebitda. So Ebitda being earnings before interest, tax, depreciation and amortization. Loan to value, a lot of you would be familiar with that, compares the amount of the loan in relation to the value of the assets secured against it. So this is the one where you may see a difference between a pillar bank and an alternative lender. A pillar bank may give you a lower interest rate, but they may be less risk adverse and therefore have a lower LTV compared to an alternative lender who may offer a higher rate, but may take more risk, offering you a higher LTV. This would be a very common covenant, as would DSC, which is debt service cover ratio. So this is the cash available for debt service, or the annual debt service cost to include interest and principal. It's a term called free cash flow. It's used by many lenders, and that is something that they look at to determine the available cash flow from operations that you have that will be able to service your debt. So what is free cash flow? It's Ebitda adjusted for any other required outgoing. So for example, working capital movement, tax, directors' remuneration, CapEx, repayment of tax, warehousing obligations, or other obligations that you would have. This is an important covenant for financial institutions or banks. It's the number of times that the total loan repayment is covered by available cash. A bank or lending institution may ask for 1.3 to 2 times free cash flow level, but that will depend on a number of factors, whether it's asset-backed security, for example, projections, the type of business, so on and so forth. Interest cover ratio is the number of times that Ebitda covers the interest payments on the loan, and can be 2 to 2.5 times. Other covenants include limits on directors' remuneration in any given year, or the bank may also require approval for large capital expenditure projects above a certain threshold. So here's a couple of examples of covenants, and what we've taken these from the previous balance sheet. So if you go back to look at them, you'll see where the numbers came from. And while there's guidelines for industry as well, what's important to know is that every business will be looked at on an individual basis, and it will depend on a lot of different factors, including the type of bank or financial institution that you're working with. How often are your covenants tested? Once a year, usually after you've provided your statutory accounts. When it comes to loan to value, the bank will assess internally, or they may get the value tested by an outside company, maybe every 2 to 3 years, for example. Looking at the DCS ratio, in this example, the bank is looking for a covenant of 1.5. So while we see that this was achieved in December 19, the reduction in cash available compared to the debt service requirements, which remained the same over the period, means that the ratio achieved is lower than required, and therefore this covenant is not satisfied. So if you were to restructure this loan, for example, and extend the term of the loan, then this reduces the annual principal repayment, which in turn may improve your debt service cover ratio. So these are the things to look at if you are concerned in the future that you may not be able to meet your covenants. In this example as well, loan to value has remained the same. And again, Ebitda leverage is also not satisfied because the Ebitda has declined in comparison to the overall debt level. So what's important to think about when you're looking at your covenants? First of all, know what they are, like know what your covenants are on your agreement, particularly if you have an older agreement. And what covenants do you have attached to those? Look to the future. Do you think you'll be able to meet all of these in the future? And if it's not the case, talk to your advisor, accountant, talk to your bank. Also, very often when you're negotiating a loan or agreement, people will stop at once they've negotiated the main terms of the loan, but covenants can be negotiated as well. And it's important actually to look at them and to make sure that you consider them. They have to be realistic and achievable. The last thing you want is that they're written too tightly. And then if you have some dip, that you aren't able to achieve them. Okay, so what if you have challenges with your current debt and you have a non-performing loan? So what is a non-performing loan, or NPL? They're bank loans that are subject to late repayment or are unlikely to be repaid by the borrower. While it's an overall term, what's important is that every financial institution or bank will have their own specific metrics on this. So no two banks will be exactly the same in calculating NPLs or if a loan is non-performing. And no two loans are the same. So it's very much on a case-by-case and bank-by-bank basis. Any changes that occur to a performing loan is forbearance. So what does this mean? It could be changes in your covenant, not achieving your covenant. It could be that you've gone from paying both your capital and interest to interest only, or it could be other changes in the main terms of the loan. So on an annual basis, the bank will evaluate your loan to determine if all your covenants are being met and if you are likely to pay. If you haven't met your covenants, or if you've had to change the payment terms, or if you are considered unlikely to pay, then the loan may be downgraded. If your loan is classified as NPL, you may be moved to a different part of the bank, a solutions department. And if you do move to this area, you will probably be there for a couple of years. What does this mean? It means that you have more frequent, or it may mean that you have more frequent reporting requirements. You may be limited in your spend, and there will be no new debt. So you won't be lent any more money. But if you're concerned at all about this, talk to your bank. So what if you are classified as an NPL? There are solutions. So before we go into whether your solutions are restructuring or refinancing, just a couple of things to think about. What steps can you take? If your loan is non-performing, or if you want more money, either you want to acquire more debt. Banking solutions are not just about non-performance. There's times when you do need to refinance or restructure for several different reasons. What will your bank or lender look at? So consider, are your taxes up to date? Do you have your latest accounts? Do you have good finance function within your business that you're able to produce quality management accounts that you really understand your business? Do you use a local bank or a regional hub? Who do you do business with at the moment? And will you be assigned a new relationship manager? So the current relationship manager may have a really good understanding of your business. Will a new relationship manager have that same understanding? All of these elements will depend on the size of your loan or your business. So for example, if you move your loans over a certain threshold, your loans then may move from business banking to corporate banking. So within a pillar bank, for example. Another question is about your finance function internally, so that you're getting the right information on your business. And that's really important, particularly if you're going to restructure or refinance, because you will be looking at future projections. So looking at debt, restructuring or refinancing. So if you restructure, you're staying within your existing lender, but you're altering your current arrangements. If you refinance, you're moving to a new lender. So there's a couple of reasons that you would do this. It may be to restructure your loans, obtain better or more suitable terms, or have a new banking relationship. And something to consider that's quite important is that, let's say at the moment you're with bank number one and your loan has become non-performing. You can refinance that loan with bank number two, let's say, and then you'll get a fresh loan status with that new bank. So you will not be in non-performing with the new bank. You'll be considered new business and you won't be on the forbearance watch list. So that is something to just be aware of. However, that said, the fundamentals of your business still need to be good. So examples of debt restructuring. So here's just a couple of ways that you could restructure your loans. You can extend the term, so you're reducing the payments. You could convert an overdraft or warehoused tax to a short-term loan. You could change the profile of your payments, your payment moratorium, or you could go interest only. You could obtain additional funding, or you could amalgamate your loans. If you do look to restructure your current payments, if they're not achieved, if you look to restructure your if your current payments are not achievable, you want to get additional funding for an investment project, then you would look at restructuring or refinancing your loans. So if you go to refinance your loans, you're going to look at another lender. There's a couple of things to be aware of. First of all, there's a potential for an increased interest rate. Like if interest rates are moving at the moment, you may get a higher interest rate with a new loan, a new lender. And there will be additional costs. So you will have legal costs. The bank may want to review the title of the security. You may have to ask your accountant to produce additional information, projections, so on and so forth. The bank may ask for an independent business review of your business, which may be an additional cost to you. Is there a break cost with your existing loan, or if you have to leave your existing lender? Do you have a break clause there? And then just consider your day-to-day banking as well. So your current account, your terminals, will these be affected if you move lenders? And are any guarantees required? So when you're looking at debt refinancing, consider what it is that you're looking for. So for example, my colleague recently assisted a business that was valued at 3 million. So the Pillar Bank offered a rate of 3.5% on 1.2 million of debt. And an alternative lender offered a higher amount of debt, 1.8 million, but at a higher interest rate of 6%. So the alternative lender is giving a higher loan to value. So the point is, what are your needs and what are your projections? So if you are going to move and you're going to take a higher interest rate, will you be able to make those payments? If you want to look at that, there's a really good simple loan model on the Fáilte Ireland website's hub, and you can use different amounts and different interest rates. It'll give you an idea of what your monthly and annual repayments would be. Aileen will show that, the link to that at the end of the presentation. Okay, so just going into understanding debt security, Declan is going to take over now and go through these slides.
Thank you, Maria. So in order to fully understand your debt facility, it's also very important to understand what security is in place, what security the lender has, and then what this type of security means for you as the borrower. We're going to look at 4 main types of security, which may be part of your debt facility, being fixed charge, floating charge, personal and corporate guarantees, and then finally a brief look at unsecured debt. So first, fixed charge. This is a type of debt security that attaches to a particular asset. In a very practical everyday example, a fixed charge is the security taken by a bank when you get a mortgage on your house. So similarly, in a corporate situation, a fixed charge usually attaches to a physical asset of the business, for example, a building, land, or a significant piece of plant or equipment. A fixed charge remains in place until the loan is paid in full, and during this period, you will not be able to sell the asset with the charge in place. When looking at a company, a charge taken as a fixed charge by a lender will have to be registered with the company registration office, and details of the charge are held by the CRO. Whereas a fixed charge attaches to an asset, a floating charge does not attach to any particular asset. It is normally linked to all assets of the company or a specific class of assets, and can be either current or future. So an example would be it would attach to stock or debtors or movable plant and equipment. With a floating charge, the business is able to trade these assets, so they can buy and sell the assets. An example in the hospitality sector may be where a business takes out a stocking loan, and the lender may seek a floating charge over the stock of the business. So the business is still able to trade the stock, so they can buy and sell stock without seeking approval from the lender. As the name suggests, the charge in essence floats above the assets. It only becomes fixed upon the assets should the loan agreement be broken and the business has entered into a default position. In this instance, the lender can crystallize the floating charge, which changes it into a fixed charge on the assets within the business at that point. Many lenders will seek a fixed and a floating charge over the assets of business when providing financing. It's important to note if you do end up in an enforcement scenario where the bank are looking to appoint a receiver, with a fixed and floating charge, the receiver will be designated as a receiver manager and therefore be in a position to take full control of the business. Whereas if the receiver is appointed on foot of just a fixed charge, they will only be able to take control of that specific asset to which the charge relates. So just looking at personal and corporate guarantees. So in addition to security, whether it's fixed, floating or fixed and floating, within a business, the lender may also seek a guarantee from a third party to provide additional collateral for the debt being provided. This guarantee can be either in the form of a personal guarantee, which is provided by an individual, who usually be the proprietor of the business, or a corporate guarantee, which is provided by a third party business, usually a parent company or a related company within a group. If the debt facility is in default and repayments are outstanding, the lender can then call on the guarantee to repay the facility. There's some important points to note when entering into a guarantee or when reviewing any existing guarantees that you have in place, is to check and see whether it's a limited or unlimited guarantee. So a limited guarantee would be, as it says, limited to a certain amount, maybe the level of the loan. There are unlimited guarantees, which would say that it's all liabilities of the borrower, either current or future, which is quite onerous. Certain guarantees will have a release hurdle in place. So if the debt level reduces below a certain level, the guarantor and the guarantee is released. Or it may be that when the company profits reach a specific level, the guarantee can be released as well. It's important to just have a good understanding of the guarantee that's in place, and it's also important to negotiate those at the outset of obtaining finance to ensure that you get the best possible guarantee that you can. And very quickly looking at unsecured debt. So some forms of debt finance will be provided on an unsecured basis. Overdrafts would tend to be unsecured, some short-term loans. The COVID support loans that have been put in place over the last 2 years would, many of them are unsecured. So in the event of a default on an unsecured loan, there's no direct recourse for the lender to the assets, as with a fixed or floating charge, but the lender can still seek to pursue the debt. They have to do this, however, by initiating legal proceedings to collect what's owed to them. This can be either by obtaining a judgment for the debt or for the amount it's due, or seeking to wind up the company. And just a note in relation to winding up a company, the limit is currently €50,000, so it's for any debt over that amount, which was introduced during the COVID pandemic as part of the measures introduced by the government. But this is reverting back to the standard €10,000 at the end of April 2022. So should you move into the non-performing section with your lender, and you're ultimately unable to restructure or renegotiate with your lender, it's important to know what options are available to the lender if they seek to enforce upon the security that they have in place. In the first instance, they may ask you to refinance the debt with another lender. If this isn't possible, they may ask you to voluntarily sell the asset underpinning the debt. In some cases, this may be doable if the asset in question isn't vital for the ongoing trade of the business. If these aren't an option, the lender may seek to appoint a receiver. This is the main enforcement and recovery option available to lenders. As mentioned earlier, if the lender has a fixed charge only, they can only appoint a receiver over the specific asset in question. However, if they have a fixed and floating charge, they will be able to appoint a receiver manager who will take over all aspects of the business. We would have seen this happening in many instances in the hospitality sector following the 2008 financial crisis, where receivers took over running many hotels and hospitality businesses. If you have an invoice discounting facility in default, the lender in that case can take control over your debtor book and seek repayment from the debtors directly until they're paid in full. If you're in arrears with your leasing facility, the lender will usually have the power to simply take back possession of the asset. And then in addition to, or in conjunction with all of the above, or the options available to them, the lender, if they have a guarantee in place, will be in a position to call in that guarantee and seek repayment from the guarantor. So formal restructuring, sorry, the previous slide covers the options that are available to the lender should they need to enforce upon the security which back up your debt finances. But we're briefly going to have a look at the options that are available to you as the borrower should the lender seek to enforce. So I'm only going to briefly touch on each of these restructuring options today as they're going to be discussed in more detail in our next webinar. The options which are currently available to borrowers include examinership, SCARP, which stands for the Small Companies Administrative Rescue Process, which was recently introduced just before Christmas, liquidations, and if you are sole trader, personal insolvency. So as I mentioned previously, the main enforcement option available to a lender is the appointment of a receiver. And in both examinership and SCARP, once these processes have been commenced, a lender will be unable to appoint a receiver while the examinership or the SCARP process is ongoing. In addition, both of them have a mechanism built into the process where a receiver can be stood down by the commencement of an examinership or SCARP if the receiver has been in place for less than 3 days. So there is an option there for borrowers when a receiver has been appointed. While liquidation is often seen as the process that brings finality to a business, it can also be used as a restructuring process. In some instances, it may be a good option for restructuring and rebooting or restarting a business. So as I said, these are all formal restructuring processes that are available to companies. However, if as the borrower you were operate as a sole trader rather than a corporate entity, there's also options available as part of the personal insolvency processes, which were brought into being a number of years ago. Again, in the next webinar, we're going to look at the area of restructuring in quite a bit more detail and stepping you through what you can do to ensure you're armed to address the situation or the challenge facing you and you understand the options that are available to you. So just as a quick summary, what we've discussed today is aimed at giving you more information on debt financing and arming you to look to the future. It's vitally important to know what are the parameters around each of the areas of your debt. So you have an idea of what's coming down the line and put you in a position to engage with your advisors, your accountant, and then ultimately your lender. Most important message is not to wait for your lender to come to you, is to initiate the discussion with them and be prepared for when you do engage with them. So thank you very much for your time. I'm now going to hand you back over to Aileen.
Okay, thanks a million, Declan, and thanks, Maria, for all those unbelievably good insights into the whole area of debt financing. It's quite fascinating. Now, we do have a number of questions, and I'm going to go straight to them, if that's okay. Just firstly, in your example earlier, just before you got to the non-performing loans, there's a question in that, is that company technically insolvent, and what are the implications? Just following on that example that you used. Declan, you're on mute.
Sorry. Yeah, so looking at the balance sheet as at December 2021, it has net assets, a deficit of €60,000. So there's two ways that you look at a company from an insolvent perspective. One is a balance sheet perspective. So that's whether you have more liabilities than you have assets. So in that case, the company is insolvent. The second one is whether you can pay your debts as they fall due. We can't tell that from the example, but if you are unable to pay your debts, whether they're your trade creditors, your taxes, repayments to the bank. If you're unable to meet them as default due, you're technically insolvent. Many companies will fall in and out of insolvency. So just because you have a deficit on your balance sheet, and just because you can't pay your liabilities as they fall due for a month or for 2 months, it doesn't necessarily mean that you need to wind up the company straight away or enter into a formal restructuring process. But you do have a additional responsibility once you are in that insolvent position. So as a director in a solvent company, your responsibility is to the shareholders of the company. However, when you enter into an insolvent position, your responsibility is to the creditors of the company. But as I say, many companies will fall in and out of an insolvent position and continue to trade. The key thing you need to look at is whether when you're in an insolvent position, you have a reasonable prospect of continuing to trade. So if the future looks bright, then you can't be criticized for continuing to trade. I hope that covers off that question.
Okay, great. Thanks, Declan. And I'll just fly through some of these questions because we've quite a few. So there's a number of questions have come in on refinancing, and in particular from Ulster Bank. So maybe you could just give us a little bit of insight that you might have, or what might happen if Ulster Bank, and when Ulster Bank leave the market.
So thanks, Aileen. I suppose we all know that both Ulster Bank and KBC actually are both leaving the market. So if you have a loan with either of those banks, your loan will be transferred. So the question that the thing that I would do is I would go to the bank and ask them, if you don't know already, are you, where is your loan going? Who is it being transferred to? And get confirmation of this. And if you don't get confirmation of this, or if the bank aren't able to tell you at this stage, then what we would recommend is that you go and look to refinance your loan yourself. So you're taking control of your business and your loans as opposed to somebody else controlling them as such. So that's that's what we would say. And then speak to your advisor, speak to your accountant, see if they can help you understand what it is that your debt, and that goes back even to the beginning of what Declan said, is that while you're looking at one loan, understand your total debt within your business.
Okay, great. Thanks for that, Maria. There's another question. So if you happen to be in growth at the moment, now I know a lot of businesses mightn't be at this particular point, but if you are in growth, what are the pitfalls in acquiring more debt to expand? And what kind of benchmarks should you be kind of making decisions on? So is there something there that you should be watching out for?
Yeah, I suppose the if you're looking to acquire more debt, the key thing, the first thing you really need to look at is your ability to repay that debt. So preparing projections and having very robust projections to show that that acquiring the more additional debt will be you'll be able to repay it, and that the debt that you're acquiring, that the underlying asset that you're purchasing or what you're spending the funds on is viable, and I suppose importantly from yourself that there's a return on the investment. As regards benchmarks, you probably also need to look at your capital restructure. Your capital structure. What your debt to equity level is, and this is also something that any lender will look at when assessing any request for additional debt. It's I suppose the ranges for your debt to equity level vary between different businesses, but in general, anything below 1 would be seen as relatively safe, and once you start getting over a ratio of 2 or higher, it starts to become risky. Another thing to consider, and perhaps maybe a pitfall, is who you're going to require the new debt from. Is it coming from your existing funder or your existing lender? If it is, in that case, is it going to be a full restructure of your entire facilities? And what will your existing lender look for as regards collateral or guarantees? And then probably even more important to look at is if you're getting or seeking the debt from a new funder. What will that new funder look for as regards security? Where will that security lie in relation to your existing funder? Will it be subordinated? And as Maria, I think, alluded to in her presentation, the interest rates that you may have to pay because it's a subordinated debt may be higher, and may result in the project or the project becoming unviable because the interest rate is too high. So I suppose they're the main sort of things that you need to look at when looking to acquire new debt. I don't know if Maria, if you have anything to add to that.
No, I think that was.
I suppose sorry, Maria, just to build on that, there's a question like, would you, in a high interest rate scenario, would you protect your variable interest swapping into a fix?
I think what I would say there is it kind of depends. You might do like a 50-50 split. So you might say, well, look, I'm going to take a 50% fixed and a 50% variable. So you are kind of holding in part of that. I don't know that you'd necessarily go totally fixed, but what you might do is a split.
Okay. Okay, great.
Yeah, I think that the general view is that interest rates are or may go up in the short term. So not to be given a direct advice, it perhaps is a time to start considering that and maybe talk to your advisor or your own accountant about it. But the general news coming through is that potentially interest rates may go up.
Okay. Okay, great. I'll move on. So maybe there's another question has come in. So it's in relation to debt financing and alternative lenders. So, what are the pros and cons around that? What are the advantages and disadvantages, maybe one over the other or whatever?
So I suppose most tourism businesses will be, you'll have your loans or your debt with the pillar banks, with the main banks. But there are alternative lenders in the market who are lending in the market at the moment and lending to tourism businesses and hospitality businesses. I think the thing that we all hear the most about going to an alternative lender, and we've said it ourselves a couple of times, is they offer a higher interest rate, or their interest rates are higher, let's say, than the pillar banks. So that's probably a disadvantage as such. But they'll take more risk. And again, I mentioned that as well. So they'll give you a higher loan to value ratio. So they'll take a bit more risk. They are quicker to make a decision. So you will find that if you apply, that you'll get a quicker decision than you may with the main bank. Another disadvantage, I suppose, is they're a bit more costly in that you may have an arrangement fee with them and you may have an exit fee with them. Now, you may want to check this as well now with the pillar banks, because we are starting to see some arrangement fees coming in there as well. So if you're looking to refinance, that's something to consider. And another item that is an advantage or maybe an advantage is if you have any title issues with your business or with your property. A main bank may have to get that title secured away or completed. So if you had an issue, they might say, well, after we give you this loan within the next 6 months, you have to get that sorted. Whereas an alternative lender may be a little bit more lenient in regard to that. So again, like I think what we'd say is it definitely goes back to what your need is and what your business is. And what you're looking for. So if you're refinancing or if you're looking for additional CapEx or investment, then certainly worth looking at all of your options.
Okay, great. Thanks. And I'm just going to put this one in as well. For, let's say, it appears that the pillar banks are not going to support new CapEx where the loan has been in forbearance. So it's just, have you any experience of that or what's happening out there at the moment if you have an interest only?
So that goes back to the point that I was saying, that the non-performing loan, that if you are in forbearance or if you're a non-performing loan and if you get moved, let's say, to a solutions part of the bank, then they're not going to give you any more money. No, so they won't give you additional funds, or more than likely they won't give you additional funds for CapEx or reinvestment. Okay. The challenge is, well, that's kind of part of the solutions area, but And again, as I had mentioned earlier, like if you looked to refinance with an alternative lender, or not just an alternative lender, with another bank or another financial institution, I should say, then there is the option for you to become a new loan with that business. However, every bank and every financial institution will look at the ultimate fundamentals of your business and whether you are likely to pay, like whether you have cash available, what your debt service cover ratio will be. But yes, that would be the case.
Okay, excellent. Thanks for that. And just one more question. So it's just kind of a general question in your experience of what's happening at the moment. Is there many hospitality loans falling into the non-performing loan section or the restructuring category due to the restrictions? It's hard to say, I suppose, but
we're not seeing a huge amount, to be honest with you, at the moment. I think because of COVID, it's quite a unique experience. I think if you there was great government supports last year that have really helped businesses. There was good domestic business last summer for a lot of these businesses. I think, now as the supports will start to move away, let's hope we have a really positive summer. I think the challenge will probably come maybe next winter, how much cash flow will you have then? Will corporate business be back? Will conference business be back? Will tourists be back? Certainly not to 2019 levels. So that's where I think at this stage, it's really important to look forward, look at your projections going forward, look at your balance sheet going forward. But at the moment, we're not really seeing it. There's been really good government supports. And I think, I suppose banks and financial institutions have been supporting their clients and their businesses.
Yeah, I was
going to say, have you seen anything else?
Yeah, just to add to that, I suppose two aspects of it. Maria alluded to sort of next year it may become a little bit more difficult. The key part of that really to look at is any taxes that have been warehoused with the revenue. None of those have fallen due for repayment yet and will only fall due for repayment starting in 2023. So that, I suppose, breathing space between now and then is an important time period for companies to get themselves set up for when they need to make those repayments on the warehouse tax, because they'll also need to pay their current taxes as they fall due. But in general, I suppose from a restructuring or a formal restructuring side of things, there hasn't been a major uplift in those. The numbers are still quite low. As Maria said, the supports that are in place from the government for the last 2 years have supported many companies and have stopped them from entering into insolvency and restructuring solutions. And the final point on it is, I suppose, coming back to the banks, when we entered the financial crisis the last time in 2008, 2009, they took a very strong stance and were very aggressive and appointed receivers and whatnot. They probably have a different attitude towards it this time, and they are much more willing to support companies. They're not as quick to go down the enforcement route. Not too sure what the reason, whether it's PR, the bad PR that they got the last time, or that they're just probably they're owned by the government in certain banks. So the pressure is there not to enforce as much as would have been the case 13 years ago.
I think as well, just to add to that point, like if you think about, their last recession as well, the position that we were in, we were much more indebted, so going into that recession, there was a lot more debt in the sector as such, whereas going into COVID, there wasn't that same level of indebtedness, I think, going into it. So we were in a stronger, I think lots of businesses were in a stronger financial position, and that as well had an impact, or is having an impact, a positive impact.
That's brilliant. That's good. And just one final question, because I know time is tight, and this kind of leads me out onto my last slide, which is nice. So around the whole area of return on investment, so we know it's important for planning any investment, your ROI. What is the best way to do this? And are there any templates that Crowe or Fáilte Ireland can recommend? So I know we have templates there for the person who posed that question, but Maria or Declan, just any way and the best way forward to do this.
Well, obviously it's projections. Like, so you have to, like, so if you're going to invest, let's just say you're adding on 10 bedrooms to your hotel, what's it going to cost you, and what's your return going to be? So actually I think well, the simple loan model will give you, like on the template, and I know Aileen, will you show them there? That'll give you an idea about what the cost will be from a debt perspective if you're going to fund it from a debt or partial debt. Also, there's your P&L scenario analysis, so that will help you do your projections. And then really, like from a owner's perspective, like what return are you looking to get? What, if you were to use that money elsewhere, what would be the difference in return that you would get elsewhere? How important is the investment to your business? Sometimes it isn't just about the direct investment, but it's the other business areas that also benefit. So those are all of the things that I would say to look at, but projections obviously are critical to doing that.
Brilliant. Well, I think that's actually all we have time for. So thanks a million, both Maria and Declan, for joining us today. Just on those templates, I think somebody's putting up my last slide there. We do have templates is the answer, and the simple loan model and the P&L scenario analysis tool were both called out, and all of these can be found on the financial planning section of our Business Support Hub. And if you have any difficulty finding those, please contact us. Also, I would say to check out our support program schedule, which is a list of all of the live supports that are up, that you and your teams can get on straight away, and it covers all business areas, not just the finance. I would like to take the opportunity basically to thank everyone for joining us today, because I know it's taken a very precious hour out of your day, and I hope you've got a lot of value from it. So the last thing for me to say is the date for our diary for the next webinar, where we will be covering the whole area of formal restructuring explained. And it's our second webinar of the Money Matters series, and that will take place on April 6th at 10 o'clock. So we really hope to see you all there. So thanks once again to our speakers and to my background team and to my enterprise development team as well for bringing this webinar to you today. And we hope to see you all next time. Thanks.